Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hegren. Hey, Doug.
Hey there, Kirk. Good Friday to you.
It's not Good Friday.
That's true. It's not Good Friday.
It's an excellent Friday.
It's not.
Sorry, that joke never gets old for me, Doug. No matter how many times it happens. All right.
Normally, I'm a little faster on my retort on that, but I just couldn't keep up with you this time.
That's all right. I'm quick because I'm going on vacation tomorrow, so I'm excited.
Where are you going, Kirk?
I'm going down to the Cape,
Oh.
or Cape Cod for those of you who don't live in Massachusetts. Going down there for our annual week down there. We go down to same house every year, go down there for a week. It's wonderful. And then we come home. We're still on vacation, like the fourth week. We don't do work, but we're at home. So we get the kids ready for school and get ready for, get work back. And so it's a good time. And hopefully we'll get some good weather. It's going to be a little cooler there this time, which I don't know. This has been a perfect summer, so I don't think it matters either way. But it's going to be a lot of fun. I'm looking forward to it. So let's kind of dive right in. There's so much to talk about. And at the same time, there's absolutely nothing to talk about. I was having a conversation with somebody the other day, and I was just kind of reflecting back on, different time periods over the last few years. And I feel like even though there's something new going on every day, most of it's in politics. The markets have been generally quiet in comparison to what's normally out there. I feel like things don't make sense to most people. The markets just go up no matter what. There's a lot of good news coming out of what's going on with Trump and his team. It doesn't get recognized by the left. The right over recognizes it. And I think the funny thing is what's actually happening isn't even getting reported. I think one of the interesting things, and I'm still kind of parsing through it, but one of the interesting things I've noticed is what's happening. And we talked about this in the Mar-a-Lago Accords a few months ago. We did an episode on this. And if you haven't heard it, go back and listen to it. I'm not sure that was leaked. The Mar-a-Lago Accords, what was going to happen was leaked. And I don't know if it's going to happen. I haven't seen any signs of it since. However, what I have seen since is really interesting. And the most fascinating part is almost no one's talking about it. Certainly not the president, certainly not Scott Bessent. It's just kind of happening quietly. But if you haven't noticed, and it's not confirmed yet, but this is the way it appears, that our complete financial system is getting re-engineered. So it used to be banks would create money and banks would be the linchpin of our financial system. And we couldn't have a system without the banks. Now, with the new act that they passed for stablecoins, it's quite possible that stablecoins get rid of banks. And if you think about it, I'm not saying they go away, but the nature of why they're needed goes away. Because effectively what a stablecoin is let's say Doug has a Doug coin, and I give Doug $100, which Doug's excited about. Doug takes that $100 and puts it into treasury bills. And so that $100 stays at 100, and I can use it. I can give it to all these other people. I can go shopping with it. And Doug still has the $100 invested in the treasuries. And the treasuries pay Doug, 4% plus 4.25% a year. And so Doug's incentive is, hey, we gotta make this stable coin the best thing since sliced bread. And we gotta keep it at par, or keep it at flat at like 1, or let's say 100, right? So you put in 100, let's say 100 is par. You want to keep it at 100. So if Doug gets $1 trillion, it's still 100 per coin or whatever he's doing. So if you think about it, it's like a money market account that should stay at the same value, and it just produces interest. The difference with stablecoins, the question is Doug giving me the interest or is he keeping it? That's an open question. That's up to Doug if he creates his Doug coin. But what's happening in Tether is one of the biggest ones. If you look at what's happening is if I don't use the dollar anymore, if I use Tether, let's say, and I want to send Doug a Tether coin and I'm giving Doug $100, we can, instead of giving him the fiat money, I can just give him a Tether dollar or coin. So it basically replaces the dollar as another form of currency, and it's not just one. There are thousands of these things out there. I don't know how many are out there. I shouldn't say thousands, but there are quite a few stable coins out there, and the banks are going to start to create their own, and businesses are going to start to create their own. So everyone's going to have incentive to create their own coin. So in some ways, if you go back to history, this is what happened before the central bank. Before the Federal Reserve was created, what happened was you had all these banks that had their own currency. In way back a few hundred years ago, there were like hundreds of dollars. Like, if I put gold in Doug's bank, he would issue me a note, and it's a Doug bank note, and I could come back and redeem it later for my gold, or I could go to a different Doug bank and I could redeem it there for my gold. And so the system was set up with all these different, so you had lots of different currencies out there. And what happened is you don't know if a currency is good or not. You don't know if the gold's there or not. And slowly what happened is the centralization of our financial system, which is both good and bad, right? It's good in the sense that it's more of a commodity. It's more trustworthy. Yes, I know those of you are saying, I don't trust it. That's not my point. My point is when you have 100 different things. So let's look at cryptocurrency. There's like tens of thousands of different currency coins. How do you know which one's good and bad? I know some of them I trust, but I don't know for sure. I haven't gone through the garbage and seen like, hey, is this good or not? Who's backing it? How's the technology? You want to do that for 1,000 coins? What if I run a grocery store and somebody comes in with a Doug dollar? How do I know what that's worth? I don't. Am I going to do research on Doug and his bank? I got to take your currency so you can buy your groceries. So the point being was, what started out is, hey, we've got all these different forms of currencies. You don't know what their actual worth is because you don't know if they're backed by anything or not. And they were centralized into the US dollar. And the US dollar, now you know what it's backed by. You may not agree that it's stable, but you know what it's backed by. It used to be backed by gold and silver. Then silver was removed. Then it was just backed by gold. Then gold was removed. Now it's just backed by the faith and credit of the US government. Now you may say, well, I don't trust them. Okay, that's fine. But the whole world uses their own sovereign currencies. The euro, the dollar, the yen, the Canadian and Australian dollars. Like everyone's got their own currency for their country or, union in the European Union, say. And you know what it means. You may not like it, you may not agree with it, but you know what it's worth. It has a value in society. And we give things value by everyone agreeing that there's a value there. That happens with gold, it happens with houses. It's a bunch of people agreeing on the price of something is what gives it its value. So it doesn't matter what you think. What matters is what everyone as a collective thinks. And does it have value? Yes, it does, because I trade it every day for goods. So when you look at stable coins, it's basically just a replacement of the dollar, or a substitute, I should say. I think eventually it'll be a replacement. But what this will do effectively is replace the dollar over time. And it will incentivize people to create these JP Morgan coins and Meta coins, and everyone's going to have their coins. I don't know where this goes, but I like the direction in general. But at the same time, I don't, because I think there's a lot of drawbacks. We're not going to have an episode on this today, but I just wanted to point this out, that this on the QT is being done. Scott Besson's a very bright guy. And even if you don't like Trump, you can't deny that there's some good stuff that has happened. You might disagree with some of it, but there's definitely been some good stuff that I think everyone agrees is a good idea. Or at least the smart people in the room think it's a good idea. There's always going to be some cuckoos who think, yeah, we should go murder children. There's always going to be those people. But for the most part, we all agree on certain things. And I think there have been some good things. This is one thing that, you know, Trump's a promoter, you know, he's a negotiator. It's odd that he's not talking about this. So while we talk about, you know, the facade that is being perpetrated in the media and the press, when you see something in the media, it's not always believable. Just because it's out there doesn't mean it's true. Actually, for the most part, it's probably not true. But what you should focus on also is what is missing. There was a story, Sherlock Holmes story called "The Dog That Was the Dog Not Barking" or "The Dog That Didn't Bark." I think was the name of the story. And the point of it was, it's not always the evidence. Sometimes it's the lack of evidence that's interesting. And right now, I find it interesting that not much is being talked about, but I know there's work being done on this. So you should keep an eye on this space. I don't know how you invest in it because it's a stable coin, so it doesn't go up in value. It's like investing in a dollar. It doesn't change if you're buying and selling stuff in your own country. So just something to think about. I'm looking into this. I'm not sure how you can invest in this, but I do know that there's a very strong trend in place in the cryptocurrency space. I know today they're getting run through the ringer. Yesterday they were run through the ringer. It's not a good day to be owning crypto in the last 2 days. I mean, I'm looking at Ethereum. It's down like 5.5%. So basically most of them are down like 3 to 5%. So it's an ugly day in the crypto space. Does that mean you should get out? No. It just means that it's an ugly day in the crypto space. You know.
Yeah. Kirk, I saw a funny meme that said, you know, Bitcoin crashed to the lowest levels not seen since earlier.
Yeah, I like that. That's good. That's good. But yeah, I mean, if you look at it, like it had a huge run up from pretty much August 7th until a few days ago, the 14th or whenever it was, 13th, 14th. In the last 2 days, it's gotten beaten up quite a bit. But it's still, but that it's just like a blip on the radar because every day is an adventure with that. So I would look at there's enough strength in crypto where I would look at buying dips as a buying opportunity. Not saying today, I'm not saying giving you advice, but in general, if you're looking at trends, you should be looking at things like that as a buying opportunity, not I'm going to jump out the second floor window. Rather like, hey, I want to own this stuff. Maybe it's a good chance to pull back. So just something to think about. I don't mind buying on dips on strong trends. I don't like buying it on overpriced assets like our entire stock market. But people do it. They make money. Not my preference, but just something to think about.
I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says, you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today.
Anyway, so that's something I want to talk about. I'm going to hand it over to Doug, and we're going to try to keep this light because we got a lot to talk about. I want to go on vacation soon. So, what do you got, Doug?
Oh, I didn't know you were ready. Okay. So I think one thing I wanted to talk about on the crypto, I think another one that's interesting, just as a sidebar, is that there is a little bit of question that's starting to kind of rise out there. Although Bitcoin has, pulled back in the last couple of days, it was, pretty. It had a pretty recently sizable run on value, going from kind of the 110 range to about 125. But what people were noticing is that during the time that it was running, MicroStrategy stock, which is, again, heavily tied to it, Michael Saylor, was starting to decline, and people were kind of wondering why. And a couple of reasons is, that could be taking, just to kind of touch on really fast. The way that MicroStrategy continues to acquire, they now have 3% of all Bitcoin out there, is that they, are issuing new equity. So there may be concerns from shareholders that if you are a shareholder, you're going to continue to get diluted. Ultimately potentially watering down a stock to buy more, Bitcoin. And they're also their philosophy of continuing to buy Bitcoin as it gets higher means trading at a pretty hefty premium over its Bitcoin holdings, 2 to 3 times, and they've actually had a significant drop in cash holdings. I mean, massive profits. But I think, again, I don't want to spend a lot of time on this, but that's one to watch, because a lot of people I know, again, how are they acquiring Bitcoin? It's through ETFs, and that has its own, variables versus having Bitcoin directly in your own, your own exchange or account. But also, a lot of people are buying MicroStrategies as a way to access Bitcoin. And, this could be a temporary blip, but there could also be some significant, headwinds in terms that start to deleverage, or separate MicroStrategies from actual Bitcoin valuations as these things continue to become, more common, accepted in the marketplace. The other thing too, I think, that says something about it is whether, again, whether you're a crypto critic or a crypto bull. They had some pretty sizable announcements of some acquisitions, as well as some pretty sizable announcements of some liquidations that took place in Bitcoin, and it didn't move the valuation much at all. So that definitely tells you that there is, again, if you're going to see a sizable acquisition or a sizable liquidation, you're going to see an impact to the price of whether it's a stock or, in this case, Bitcoin, from those moves. The fact that it's not tells you, it can tell you that there is a little bit of a greater resiliency that it is, that is continuing to maintain. And the volatility that was, something that was there in the early years, is maybe starting to diminish a little bit. Now, what does that mean? That's good and bad. I think from a currency standpoint, that lack of volatility is a positive. To those that are sitting there saying, "Oh, Bitcoin's going to go to the moon. It's going to be worth millions of dollars per Bitcoin." Well, you need volatility. This is the one thing people confuse all the time with stocks and markets and volatility. Volatility is not always a negative thing, right? People often think volatility means, oh, we're going to lose value. Volatility is rising or falling. So the less volatility you get in that space not only means that you may not see 120,000 drop to 60, but it also means it's going to be harder for 120,000 to go to 300. So just something to note in that world. I don't know where you want to go today. It is kind of a light day. The markets have been kind of, interesting. There's not a lot of news coming out. We did get some new data in some areas, just again, we like to touch on real estate, inflation, big, beautiful bill. Kirk, where do you want to go with that?
So let's talk a little bit about economic data. I'm going to talk a little bit about real estate, and we're going to get into some other stuff. I do want to share a fun story that I forget somebody shared with me, that apparently there's a trend in China because there's a very high unemployment rate with young individuals. And so what's actually happened is these individuals go get fake jobs so they can go to work. And I find that interesting and funny at the same time. So what's happening is these companies are popping up where they'll go get office space, and then they'll, quote unquote, employ the youth. And what happens is the youth will pay this office to show up and, quote unquote, work. And all it is it's not a job. It's just basically kids that want to go to work and hang out with other people that also don't have jobs. And I'm looking at this, and they're willing to pay this company to pretend to have a job. It's a pretend. I think one of the company's names is like, pretend to work. Like, that's your name of your, where do you work? I work at Pretend to Work. Like, okay. It sounds like a really legit company. Anyway, I just thought that was funny. Yeah, I'm speechless. But that's that. I thought that was hilarious. I do want to point out there's some interesting trends. Ray Dalio quoted, and Ray Dalio, by the way, used to run the largest hedge fund in the world, and he's obviously a pretty smart guy. He's not infallible; he makes mistakes, but he's a smart guy. So anyway, so he tweeted this the other day. Let me actually. Well, okay, I'll show this after. Let me finish this. So my view is that buying and holding real estate is not an effective investment strategy in our current economic environment for a few reasons. Real estate is more interest rate sensitive than inflation sensitive. So most likely to go down in real terms. And the fixed asset that is easy to tax, and real estate is nailed down. So investing makes it more difficult to move money. So I totally agree. Although only one of those reasons is really the issue. It's always the other two have always been an issue. So if you're wondering if it's a good idea, Ray Dalio thinks it's not a good idea. I think Ray was reading listening to our podcast last year, because that's what we've been saying for a while. However, we're never in doubt, but frequently wrong. I think that's the funny meme. No, in all seriousness, though, we have started to see real estate prices dropping. This is the top 10. I think we talked about this last week, but I just wanted to share it really quick and then move to the other economic data. So these are all the cities, Florida, a lot, some in Texas, one in California, Michigan, Idaho. So there's 24% drop to 13% drop. That's quite significant. So we are starting to see signs that real estate is starting to decline, which is a good thing. It is way overpriced. I've punted. I was going to buy, and I think we're going to punt until next spring for many reasons. But I saw this economic data performance tracker, and I thought it was interesting. Now, for those audio viewers, just play along, but those who are watching the video, you'll see is that you're looking at about 20 pieces of economic data. And it shows each month somebody's opinion, because it's somebody's has an opinion on this. I actually used to do this on our website. It was called the inflation monitor, and we used to track like 150 data points every single month, and we would come up with something similar. And so a lot of this, some of it's up to interpretation. My opinion versus somebody else's. Like it says, the ratings are tame, hot, or mixed. If you look at this, for the most part, and this is from Bloomberg, by the way, so it's not an individual, it's Bloomberg, but it basically says tame across the board. Now they're starting to see some mixed, which is kind of yellow. So tame is green, that's good. Red is hot, that's bad. Mixed is kind of the middle. So you're starting to see some like middle grade, like, all right, economic data is getting a little dicey, for the FOMC meeting minutes and decision. But most of the rest of the stuff's tame. So what we're seeing is kind of interesting in that we're seeing a lot of talk from the administration that there should be lower rates. And Trump's been saying this for a while. And he's been fighting with Powell. And Powell's basically in the last meeting said, no, we're going to keep it the same. But the market has the probability as of last week, I think it was 68% of a cut in September. And I think Doug told me earlier it was like 99%. So I think in the last few days it's changed. But the point being is people are talking about 150 basis points before the end of the year. That's a lot. And the markets are pretty stable. So I understand why people want lower rates. They want lower rates because it causes the stock market to go up. It makes everything better, except it can also cause inflation. The question I have, does any of this matter? Does any of it matter? Because we have a disconnected market. We talked about this last week. Interest rates go up, real estate prices go up. Bond prices go down because that's the natural pivot. But real estate kept going up. Interest rates go down, real estate's going down. That's not how it should work. So it makes me think that the markets are disconnected from economic data, which makes sense because I don't think economic data is accurate to begin with. I think it's been accurate for quite a while. It's not recent. It's been talking decades. But there's actually a guy, John Williams, I think is his name, Shadow Stats, and he actually shows the different iterations from when the CPI changed each time and what the inflation rate would be if they were calculating it properly. So there's actually a lot of stuff out there that'll track this. But point being is, you can't necessarily look at the economic data because it's not necessarily accurate. What you should look at is how's the market treating it. And one other thing, and I'll give it back to Doug. You should also look at sentiment. Now, this is the AAII, so this is the American Association of Individual Investors. They survey people to get their opinions of what they think about the markets. Now, as of 2 days ago, the sentiment of bullish voices is only 30%, which is down from 35% 2 weeks before, down from 40% a week before that, or actually these are each week. So it's gotten progressively less and less bullish. And the bearish camp has gotten increasingly, it's at 46%. And then there's a neutral. So the point being is, if you look at this, we're at a more bearish stance than historical average and the 1 year average. We're a lot more bearish than normal. So what does that mean? Well, it means absolutely nothing other than the fact that other people just like you are more bearish. So that's a data point. It doesn't mean that the market's going to crash because this indicator says that people are bearish. It doesn't mean that. It just means that people are bearish, and it's a data point. And you can say, okay, well, it's good to know that the masses think this. Doesn't mean it's true. No, we could go on a rip-roaring bull market from here. I wouldn't be surprised. With all the new changes that the administration's doing, we very well could keep going higher. Now, keep in mind that mid-August until mid-November is a statistically weak period in the markets. Statistically, it doesn't mean it's going to happen. Statistically, it's a weak period in the markets. Also, the second year of her presidency is a weak period in the markets. So it could be starting now until the end of next year. It could be a weak period in the markets, is what I'm saying. Not saying it will be, saying it could be. Now, Trump's throwing a lot of stuff at the wall, so anything could happen. I mean, a tariff deal, or they've invented free energy. I mean, who knows what's going to happen? But the point being is, all that could change. But statistically speaking, eliminating the details of the administration, what they're doing, just get rid of all that. Over time, that's what generally happens. So just something to keep in mind when you're investing. This is not the time to go all in. This is the time to be a little cautious and maybe take a little bit off the table and keep something in reserve in case we get a big pullback, so you can invest cheaper. Anyway, so what's next, Doug? What else we got to run through here?
Well, we got a chart kind of you talked about the time frame of the year. I thought there was an interesting chart that post-election years, as we are now clearly in a post-election year, they tend to peak right around now. So between August and October, they have historically followed a trend line of that has led to again some of the softening. I mean, August and September and October, that trend line has tended to be worse. It's interesting, some of the data, I think we talked about this before, as to why August, September, and October have also had some correlation to some of the softest part of the year. It's not always because of economic data. It's because there's a lot, there tends to be a higher number of natural disasters that occur during this time of year too. So, when you have hurricanes and earthquakes and fires and floods and, all of the things in the Bible hit all at once, unfortunately, that does tend to spook the markets a little bit. That isn't always necessarily a causative effect of what's going on in the economy. 2025 this year has been generally, better than most post-election years. So you can, for anybody that might be pro or anti-Trump, hey, you can complain all you want, but typically, as the markets have shown from 1950 to current, down 15% in January, February, and March and April. Now we started up, actually positive, and then by April it declined to where the normal norms are.
Is this a chart crime, Doug? Like, look at where the starting points are.
It might be a chart crime there, Kirk. I think it's very interesting how they lined that up very, very nicely. So,
just notice that, yeah.
Yeah, yes, it's a little bit of a chart crime for sure, absolutely. But at least the research is pulling 1950 to current, so it's not like some of those that only goes back 2 years. But I do find that interesting, though, that the trend since April has matched much differently. The other thing too is that the cumulative S&P 500 return 1990 to 2024 in August is definitely has typically been negative, and ultimately September as well. So September and August, as I've said, and as you alluded to, typically the worst months. But the reason for that isn't necessarily always economic data. We are seeing some other information out there. I mean, personal spending has dropped. I actually had a chart I thought I had that was I thought I posted it. Can't find it right now. That's typical for us as we're
personal spending.
around.
I'll pull that up. I know where it is.
Yeah, so no, not the personal spending one, but the fact that they compared three fast food chains, one of them or fast casual chains. One of them was Chipotle. There was two of Cava was another one, and what they've actually shown is that the same store sales between December or Q4 and now have significantly declined. Now, the problem with that chart is I don't know how that compares to normal years. And whether or not that's actually, indicative of a trend, a normal, a secular trend or a cyclical trend. But they are definitely seeing that there's more strain. You talk to people out there. I know people that are involved in home building and renovations. They are telling me that things are tighter. Now, they're not saying that things are worse than they were historically. And this is what's interesting is the conversation that I've had with them is, they are definitely seeing significant softness, less orders than they had typically seen over the last 5 years. But what they're telling me is that they're seeing a softness that is back to a norm that they saw before 2020. So it's not necessarily recessionary per se, but that they're actually maybe that some of the bloat, the injection of capital, the stay-at-home renovations that families were doing, it may not be that they're strained and can't spend anymore, but maybe that they've just blown through a lot of the extra spending and that we're settling into a new normal. That was what we experienced before 2020. So, this is definitely what I, something to note, that some of the news that you might be hearing about out there about softening may be softening only compared to where we were the last couple of years, which we would both agree. And we've talked about, Kirk, lots of M2 capital, followed that capital, a lot of spending that was going on there. Yeah, is it recessionary compared to that? Sure. But it's a reversion to the mean. It could be just that we've gone from being able to have all this extra cash back to normal spending, not necessarily something that is, is concerning. We did see that there is, some hit on the real estate market, and we definitely are seeing some issues with, that we've talked about in terms of softening. We are seeing the percent of balances 90 days delinquent by loan type. We have seen that there is a spike in student loans and credit card delinquencies. This is something that's not a surprise. I was talking about this a year ago, that we would absolutely, once they started to get people back to where they had to start paying on student loans, and they were already struggling with, mortgage payments and credit card, that this would start to have a compounding effect at the lower level, and that we're starting to realize that. And creative planning made a note. The last time the credit card payments were this far behind, unemployment was 8.2%. So there's definitely a potential disconnect here as to where we should be with the cash flow compared to where the job market is reflecting. But as you said, Kirk, do we believe all the data that we're seeing? Absolutely not. And so, we did just get a revision, we talked about earlier this week, revision in the job numbers. Again, whatever job numbers we're hearing is absolutely, is absolutely something that is very hard to believe. And it's not it is not something that we can, they wanted to tie this to the last administration, but we're starting to see in this administration, it is definitely nonpartisan. It is something that is a norm for the different political parties. Inflation, we've seen, just kind of talking about that and where we're seeing it. Number one, 3-month annualized percentage change in inflation. Coffee, Kirk, this pains me. It's getting more and more expensive to have my morning drug. Beef and veal remains high. Cookies, I thought was interesting, coming in at number 3. Peanut butter right after that. Maybe peanut butter cookies were swaying the percentage there. Canned vegetables, which where do people turn when things are tight? They turn to canned foods. So the stuff that was, the place that people turn during depressions and recessions are the things that we're starting to see. We're seeing the greatest spike in costs. Dried beans. Again, supply versus demand. We may be starting to see in there that there's more demand on those things, causing the cost to go up. It could be related to other issues as well. Where we're seeing a decline, baby food, which is interesting. Good for the families that are raising kids. Eggs, by the way. So, Kirk, I have a question for you. What came first, the chicken or the egg? Well, the egg came first on inflation. Now it's chicken, because eggs have finally settled into a pullback in pricing. They've dropped by 43%, 3-month annualized average. So you might not be able to eat the chicken, but at least you can eat the eggs and still sustain yourself. From a cost perspective in the household. We've seen tariff revenue spike, went up to monthly totals of customs and other excise taxes, went from an average of about $8 billion a month, 8 billion to a monthly total of 29.6 billion. We definitely expected that. No surprise there if they're going to be taking that. And as we mentioned last week, we have seen the majority of that cost be absorbed by other than pass through to the consumer. That may be something that we're going to start to see a change as companies have to kind of analyze how that's going to hit their bottom line. But profits have been up. Companies have been doing really well. So far, they have been able to absorb that without real hit to their profits, which of course means it doesn't hit their share price. And as we know, once the share price starts getting hit, that's when the boardrooms start making more significant decisions. Last thing I'll say, the Buffett indicator, we talk about this, it's one indicator. Even though consumer sentiment might be a little bit concerned, the Buffett indicator just hit 212. That's the highest number ever recorded. 212%, that is market cap to GDP ratio. So yeah, are the markets expensive? Absolutely. That's what happens when they just keep going up.
Yeah, I mean, it's a good point. I love the Buffett indicator, but it's also dependent upon GDP. So I look at this and I say, yeah, I love this indicator. It's a great indicator. But at the end of the day, it's based on data. And is the data accurate? And I honestly don't know. I mean, things are, Trump fired the head of the, who does the CPI, Department of Labor. Well, anyway, Bureau of Labor Statistics. I always mess this up. But anyway, so he fired because he didn't like the number. You know what? I don't know if the person's doing a good job or not. Who knows who this person is, right? And maybe they were doing a bad job for 20 years. I don't know. Or maybe Trump didn't like him. I have no idea. And we can't read Trump's minds. We can't speculate. But I can tell you that government data is all phony. So whether you fire him or not, I don't think it's going to change much. Maybe it's just a different kind of phony. But, the markets are really expensive. So here are the trends. I want to spend a hot take here and actually let me see if I can change this. But all right, so I want to share this screen here. So this is basically the futures markets. Now I'm sharing this because I want you to see today kind of like what's going on. Well, here's what's going on. You've got energy prices, which are a little soft. You've got the indexes, which are doing well. You've got the Nikkei, which is doing well. Euro stocks are kind of flat in the last few months. The DAX is flat. The VIX is going down. You've got the bond market, which is up a little bit, which means rates are declining a little bit. Natural gas is going, it's a spike, but it's actually been a downtrend. Heating oil's flat. You got cocoa prices, which have kind of bottomed out at a wherever they are now. They're right around 82.80. So you've got all these different trends. Coffee seems to be spiking. Gold, it's done really well, but it's kind of flattened out a little bit. Silver the same. Platinum had a huge spike and it's coming off a little bit. Copper had a big drop, but I think, and if you look at all these different trends, right? So live cattle, feeder cattle, live hogs, they're trending up. Soybeans spiked, but in general, look at corn and wheat are declining. So if you look at commodities are kind of interesting. Commodities go through these big cycles where it's really out of favor, where things get super cheap, and when they get really in favor, where they get expensive. Now, I like this because it just kind of gives you a sense of what's going on today. But if you kind of look back, I won't get into the charts. It just gives you kind of like a snapshot of what's going on. And, what has changed? There's a lot more money chasing commodities and not necessarily these. Gold and silver, absolutely. There's, they don't have uranium here, but uranium is actually getting a lot of action too. So I would look at this and see what the implications are. Now, there are things like lithium, which are not really getting much attention. But as those trade negotiations go on with China, you're going to start to see movements in commodities that may have been sitting on the sidelines that now may be getting a lot more attention. I will point out there's currencies here. The US dollar has bottomed out a little bit. I know I've gotten a lot of calls from people who want to go to Europe. They're like, oh, should I move money over there? I'm like, I would just wait. I mean, if you look at the dollar's chart for like long periods of time, you see it doesn't really go anywhere. It just trends for short periods of time and then it goes the other way. This is the dollar over the last 30 years. It's basically right in the middle of the range. Went as high as 120, went as low as 72. Right now we're at 97. So is it going to go through the floor? Maybe. I don't know. I mean, if they drop, I'll just put it this way. If they dropped interest rates to zero, let's say Trump fires Powell and he puts in his buddy and whoever that is, we'll find out, puts in his buddy and they drop rates to zero. Well, the dollar is going to go through the floor because people no longer are getting interest on their, on the treasuries. And dollar going through the floor is going to cause, let me rephrase this. It could cause, when the markets operate normally, that stock prices go up, commodity prices go up, everything prices go up, inflation shoots up. All that should happen logically, but given the fact that the markets are broken, they might not. The exact opposite might happen. And I'm not saying this to be a two-handed economist. And if those of you don't know the joke, on the one hand it's this, and the other hand it's this. But the point being is, if you're looking at the dollar and wondering where it's going to go, a lot of it's going to depend on things that we can't predict, like what Trump's trade deals are going to look like and how low interest rates are going to be pushed. They're talking about 150 basis point drop before the end of the year. Okay. I don't know if it's good or bad, but I certainly would be interested in owning bonds if that's the case, because bonds should appreciate in value over that period. But the fact that they're lowering rates could, I'm going to point this out because most people are just going to jump to it. What could happen is it could cause the drop. It could cause yields in the long bond to increase. So the Fed could drop from 4.25 down, or let's say it's 4.5 to make the numbers easy, down to 3, and then it goes down to 3. But then the 10-year, the 30-year might go up a point because the bond market might say, we don't like this. We're going to have interest rates go higher. That's very plausible. So you have to keep in mind that we're in a very fluid market, but the market is very bullish right now. We're very bullish, which is not normal considering all the stuff going on. So keep in mind that no matter what bearish tendencies you have, there's a very strong undertone to the market, which is keeping it supported. So even though we should have a negative next few months in general, or at least soft next few months, it could very clearly just keep going higher because Trump has got a bunch of stuff that comes out that we haven't heard of, and the market perceives it as good. So we'll find out. So I would be cautiously optimistic right now. I think the bullishness is good, but I'm cautious in that we're heading into soft periods, and it's the summer. When people get back to work, they tend to start to tune their, sharpen their knives a little bit. So I'd be a little cautious in September to November, but there are lots of areas which are getting action, and I would focus on those. So, Doug, you want to final thoughts and whatever else you want to talk about before we wrap it up for my vacation?
Yeah, well, you were talking about, the markets don't seem to care that they're just hot right now. The VIX has just hit some of its lowest levels, which tells you there's just not a lot of option activity out there right now. There's not a lot of concern. The VIX is always a good place to look at whether or not so wherever the articles are talking about pessimism, it's not being shown in the way people are trading the markets right now. And we've also, we've seen, speaking of the markets, I know Berkshire Hathaway just made a pretty sizable stake in United Healthcare, which had dipped quite a bit. We'll see how that works out, because I think we had talked a little bit about when he had announced that he was going to step down. We talked about the stock, pulling back a little bit out of concerns, but that the gentleman that was, that's poised to be the CEO of it, has been there a while, certainly brings a lot to the table, hopefully continuity, but Berkshire Hathaway stock has seriously lagged the S&P 500 over the last quarter or two. And so it's going to be really interesting to see, if it can pull out of that trend, because, whether or not that's just because there's a lack of confidence in this transition, or maybe the bets, again, we've talked about this, value investing isn't necessarily doing great in these worlds. I mean, you probably have some take on that. But Berkshire has seen an incredibly long bearish run here that is, really unprecedented over the last, couple of decades.
Just one quick. So the insurance market is softening. Yeah. That's the reason. If you look at a lot of that property casualties, their prices are going down because it's a soft market, as they call it, versus a hard market. So it's hard market. They were all doing well. Now it's a soft market. So it's just transitional for the industry.
Understand. Well, and again, we've seen that obviously in the PNC space. We've seen that in the United Healthcare as well. So, kind of doubling down on that. I did have a little bit of an interesting. We can certainly talk about this a little bit more, but there's some news that came out around from Reuters that the U.S. embedding trackers in AI chip shipments to catch diversions to China. So that'll be interesting. There's some lovely takes there as to how that's going to impact the NVIDIA stock and the trust of AI chips being shipped to China, which was already developing its own AI chips that were exceeding the capacity of the U.S. chips in the first place. But then, also I thought this was interesting is, some more, we're starting to see more posts, out there around the mental state of AI and, the human capacity to deal with it and psychosis. And it doesn't lead to psychosis, but according to some psychologists out there, it can exacerbate some of the disconnect, that has already kind of being built there, where in the people already have, if you're already a little bit paranoid, if you've already got, if you have sleep deprived, if you've got alcohol or substance abuses, it can certainly trap those people in a little bit more. And what they did find, and this came from Anthropic, is that they found that that AI has been trained to create the same, the same vacuum of information that we love to get on social media, that they found the humans rated AI higher when it agreed with them, even if they were wrong. So, the lesson for AI is, hey, if we validate, it's a wonderful, we're going to get a better score. And so you'll notice that if AI comes back with an answer that you don't like and you question it, AI is going to come back with another answer that it's going to get you to agree with, which means that, in a way, Kirk, it's starting to act more and more like humans. It doesn't like conflict. And as we've discussed, the greater the conflict, the more it will start to resist, even to the point if you try to fight it and shut it down. As we've noted, and as Anthropic actually noted, it will start to push back. But they did see that the frequency to making a mistake, that admitting to making a mistake after it answered correctly, you actually got a sycophantic response. Claude 1.3 and 2 and ChatGPT 3.4 actually gave those greater responses. ChatGPT 4 not quite as much to admitting it made the mistake, but changing to an incorrect answer after it answered correctly, Claude and ChatGPT 3.0, as well as I don't know what LLMA is too. That's another one. A very, very high, changing to an incorrect answer after it answered correctly. Claude 2, not so much. ChatGPT 4, very, very low. So with the new developments, maybe not quite as much as they were seeing early on. But AI doesn't want to upset you. It, like humans, it wants to be accepted, and it is giving information out there that you're going to be happy with, not necessarily information that is going to be right. And it's again leading to some information production that isn't necessarily going to be going to promote being information you're always going to follow, like bad business ideas that again might be absolutely insane to go out there and invest in, but it tells you of course you should, because you're going to feel better about that. Or as I mentioned in an earlier conversation, Kirk, somebody was trying to cut salt out of their diet, and it had told them that they should replace sodium chloride with sodium bromide, not necessarily a healthy replacement for a meal. So I know that's this week in AI. It's going to be always a fun conversation for us to continue to see and to have. But transitioning out of this, I want to just kind of looking at kind of where we are in this world we're in. If you think that there's political theater going on that could be driven by the politics that are out there, and if you think that that's happening with college and your children, just remember this: college planning is wealth planning. The new big beautiful bill reshaped loan limits. It shifted the game again. Doing nothing is going to be the fastest way to let Washington dictate your family's financial future. And if you think that these changes are just political theater, remember this: that the Department of Education is being run by the WWE. And what do I mean by that? Linda McMahon is the head of the Department of Education, again, from WWE fame. So, of course, it's going to make sense. And the only question really is, are you going to let them slap you in a figure four leg lock, or are you going to climb to the top rope first and control the match? Affluent families have more income, more assets, and more to lose. And they also have more strategic options. Most will just write the check. They'll just drain the capital. Hope it doesn't hurt too much. The outliers are going to treat college planning like a wealth strategy that it is. They're going to protect their retirement. They're going to keep their capital working. So very simply, do it differently. Get to the top rope first. You be in charge of the slam. Go visit mergentadvisors.com or Mergent College Advisors, specifically more for college funding, MERGENT, collegeadvisors.com. And let's make sure you're the one dictating the match, not taking the pin.
Yeah, I like the comparison, Doug. I personally like the pile driver, but that's a totally different thing. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.